On this evening's program, consumer optimism rose. Long-term rates are down, earnings are up, tax rates are low, and business health is high. We're going to debate the greatest story never told. It's recession versus recovery. Joining me now is Nouriel Roubini, professor of economics at NYU and chairman of Roubini Global Economics. John Rutledge, former Reagan economic advisor and chairman of Rutledge Capital. John Mauldin, president of Millennium Wave Investments and editor of Thoughts from the Front Line, which reaches, by the way, 1 million readers a day. And J.J. Burns, president of the wealth management firm J.J. Burns and Company. Okay, welcome, everybody. John Mauldin, let me go to you first. If the economy is so bad, why is this stock market so good?
It's not that the economy is so bad today. It's the economy is going to be getting worse. We can go back to August of 2000. And what was the stock market doing? It was making brand new highs, but the yield curve was inverted. And every time the yield curve is inverted for a substantial period of time, which it has done now, we've always had a recession. Whenever the leading economic indicators go down for 6 months, you've always had either a recession or a serious slowdown. There's a lot of other indicators. You can
Let's hang on that one for a minute.
The point is, those are coincident. What we're saying is the economy is going to soften, and when you have a softening slowdown, you've got to be concerned about the stock market.
All right, John Rutledge, the inverted yield curve is a point. There's no question about that. That's a negative point. On the other hand, I always believe that markets are very efficient and they incorporate all the information available. Indeed, one thinks that markets are stronger and smarter than econometric models, for heaven's sake. So I guess my question is, what does the inverted yield curve know that the stock market doesn't seem to know? Because if stocks are looking out 6 to 9 months, they're saying the economy is going to be fine.
All the inverted yield curve means is that the Fed put the Fed funds rate up too high. And it's going to come back down. The yield curve will stop being inverted in the next 6 months, but it's going to come about because the Fed lowering the short rates, not because the long rates are going up. Goodness, the long rates have dropped from 5.25, 5.30 for the 10-year. Today, 5.58, middle of the day. That means people are not worried about inflation long term, and they shouldn't, because there's a lot of capacity, and central banks are not printing demand.
Follow-up. Will there be severe economic consequences because of this Fed mistake, taking short rates up too high?
Truth is, I think, Larry, it probably nipped it in the right time here, because usually they kill the economy by pushing credit to the point, jacking the rates, shutting down the banks and stopping bank lending. Bank lending is still quite strong. It's flattened out for big banks, but still going on for small ones. That's where companies get working capital. Recessions happen from small companies going down, not the big companies.
Nouriel, will there be consequences because the Fed funds rate is too high?
It's too high, but the yield curve is telling you that people worry about the recession. I think that's an inverted yield curve is telling you. If you use the Fed model...
How do you put that in with stocks? That, to me, is the conundrum, and I'm being very serious now.
Honestly, I think this stock rally is a sucker's rally, because right now people believe the Fed is going to ease, and that's going to save us from a recession. Same thing happened in 2000, 2001. In March of 2001, we entered in a recession. 95% of economists forecasted no recession. In April and May, S&P went up by 18%, and then it collapsed only from June on, more than 20% when people realized we are in a recession. Same thing is going to happen this time around. People believe the Fed is going to rescue us. That's not going to work. We're going to have a recession, and then the stock market is going to collapse.
J.J. Burns, suckers rally. J.J., you out there? We may have lost J.J. Burns. Okay, John Rutledge, suckers rally. That's what Nouriel is saying.
No, the difference is then the stocks were priced sky high. We've had falling multiples and 15% earnings growth now for some time. The earnings are growing because the opportunities around the world are so strong. A long bond below 5% means we can see another 20% up in this market.
Can we put I want to put those real interest rates on the screen again and just take a quick look at this and get Nouriel. I want to get everybody to comment on this. Yeah. We have the tips rate and we have the break even. All right, first, there's the federal funds rate, and that is adjusted for the expected inflation from the inflation adjusted or the tips market. Now, that's gone up a whole lot from minus 1.7% to almost 3%. Now, I think that argues for Nouriel's recession scenario. That is a negative along with the yield curve. On the other hand, put back the inflation here. The bond rates have been falling. That's a terrific thing for the economy and the stock market. If you take a look carefully, enormously. The yellow line, that is the real 10-year. That hasn't fallen very much at all. What has fallen is the inflation spread, the blue line. That has come down enormously. Now, JJ, are you hooked in yet? All right, JJ's still not hooked in yet. Let me go to John Mauldin then, bring you in. What these charts tell me is that the growth outlook from the real interest rate is okay. It's mostly lower yields from lower inflation fears. Isn't that a big plus, John?
That is a plus, and it's why we probably won't go into a deep recession. We'll just have a mild recession or a serious slowdown. If you go back again to August of 2000, September 2000, you could see the exact same scenario. What happens is you start having to say, this time it's different. And when you get on a trading floor, those are the four most dangerous words in the world. It's very hard for me to look to be sanguine now and say, well, things are going to be different when we haven't had it one time in history.